Nearly every single stock in the market is down today, giving us a great opportunity to find 6 undervalued dividend stocks to buy now. As always, we're going to run through each one of these. They're near their 52-week lows. We're going to take a look at their dividend safety, look at the supporting metrics, free cash flow, ROIC, debt levels. And as always, we're going to run each one through the valuation model. We're going to get to our own intrinsic value, our own acceptable buy price, as well as incorporating our margin of safety, and look towards Wall Street, see what implied upside they have over the next 12 months. So let's jump straight into stock number 1, Starbucks. Now we have a double buy rating, seeking alpha at Wall Street. Although we do note a hold from Quant, as we can see, it is trading right there towards its 52-week lows, and this does have a forward yield of 2.84% with a forward P 22.38. That isn't too far off the S&P itself right now, but we will look at the sector as a whole to compare it for a more relevant metric point. Over the last year, it has been battered down 20%, but if you have been a shareholder over the last 10 years, you would be up around 109%. Bear in mind, if you're reinvesting your dividends, it would be slightly higher, and we can in fact see all-time highs July 21 at $126. Now, when we take a look at their dividend safety, it is sitting at 60, borderline safe. We will touch upon that shortly. Market cap, 91 billion. It is a large cap company, and in fact, their safety rating was downgraded on the 1st of May this year. What this effectively means that it is a moderate risk of a dividend cut over a full economic cycle. Now, in terms of looking at the last recession, the Great Recession, in fact, of 07-09, they didn't pay a dividend, so we have no comparative data, but they had negative 6% sales. That is above the average of the S&P at negative 12, but they did trail the S&P negative 69 with the S&P negative 55. Now, dividend growth, quite nice historically, 7.5% September last year. Double-digit increase over the last 5 years, 17% to be exact over the last 10 years. So it has historically been a great dividend growth company, and they have been increasing those dividends for the last 13 years. Now, as always on this channel, we do focus on the dividend yield theory. For those that are new, it does state a company is undervalued when the current yield sits above the 5-year average. So we have a sign of undervaluation here. In fact, for today's episode, a double undervaluation, forward P 21.2, significantly lower than the 5-year rolling of 29. Just bear in mind, we're not looking at any of these models in isolation. We will conclude shortly. And consumer discretionary for essentially the sector does sit much lower at 14. Now, one thing we do focus on is the free cash flow payout in terms of dividend safety. We do draw your attention to this. Earnings is susceptible to manipulation by management through accounting, and we can spot potential dividend cuts by looking at the free cash flow payout. My personal essential blanket rule, below 60%. If you want to be industry specific, 50% for restaurants. Now, 2022, very high at 90%. Nice to note it has come down to 67 in the full year of 2023. 71% anticipated over the next full year. Now, a little bit higher than what I want to see at that 60%, but nothing too bad to note. No red flag indicator, so we can continue moving forwards. In terms of free cash flow, as always, increasing and consistent. Not something we particularly get with Starbucks. Yes, it has increased from the negative position in 2014 to 320 in 2023, but again, we can see some inconsistencies over the longer term. Also, relatively minimal movement anticipated into the next 12 months. So let's take a look at sales growth. As always, 3 to 7% on a borderline rule. And what we note, pretty much double-digit growth every single year, bar that justifiable COVID year. 7% though on a trailing 12-month. And if you've seen our in-depth deep dive on Starbucks, you will notice that for the 2024, they aren't expecting much more growth than just low single digits. In terms of numericals, well, we can see they have more than doubled their top line over the last 10 years. And while they may inconsistently do share buybacks, they have bought a lot of shares over the last 10 years, essentially returning excess cash to investors by giving them a larger portion of the company. In terms of ROIC, very important metric, one of my favorites in fact. I want to see 10% or more, 12% plus, again industry specific for restaurants, ultimately giving me faith that management are able to effectively allocate their capital. Very strong across the board, in fact recovered strongly from the lows of that COVID year at 9%, 33%, making it incredibly attractive for investors as well as those who are looking to add this in the future. In terms of margins, well, above 16%, pretty much straddle around that, so nothing great to know, but also nothing poor, pretty much just around that minimum levels we want to see. With the free cash flow, whilst it has been inconsistent, over the longer term looking very strong, 10% over the more recent period. Now, net debt to EBITDA, a very important metric. Why? Well, it does correlate to both balance sheet strength as well as dividend safety. EBITDA referring to earnings before the interest, tax, depreciation, amortization. Below 3.5 again for restaurants as a whole, and what we note, these numbers below are the number of years it would take the company to pay off all of their debt net of cash on hand. 2.06 in fact for 2023, estimated to be pretty much around that over the next 12 months. So it is below the maximum 3.5 that we want to see. So far the dividend does look okay based on the information that we do have. Now let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now on this channel, we do run through every single one of these models in detail. Today's episode though, we are jumping straight into that intrinsic value, and it does come to just over $100. Now, in terms of the current price at 79, not too far off its 52-week low, we do use a margin of safety of 10%. Remember, we only execute on that if it meets our 3 golden criteria. Wide moat, strong financial metrics, good forward-looking data. If you believe that, we'll buy up to $91. Then we keep going till it's near the current trading price. And in today's episode for Starbucks, we do see a 20% MOS level. Now, what about Wall Street? Well, they do indicate this as a buy. They have upside of 16% over the next 12 months with a price target of $92. So 20% MOS level for Starbucks with 16% implied upside. But as always, let us know your thoughts in the comments below, whether or not you are adding to any of these 6 stocks. Now, before we move on to the next stock, just to let you know, we've released our latest free weekly article. If you want to gain access to any of these, all completely free, do click on that pinned comment below. For example, if you want to find out undervalued stocks, all the screeners that we use, the websites, even on the channel, you can read it in this article, or in a more recent article, high quality undervalued dividend stocks. We do run through 12 of them that we do believe are very attractive. Now, as always, completely free, do click on that pinned comment below. So then we move on to Kering SA. Now, this has been hammered down 43% over the last 12 months. Pretty much trading bang on its 52-week low, as we can see, down nearly 7% today with a buy rating from Seeking Alpha, a yield on a trailing 12 months of 4.37%, and a P on a trailing 12-month basis at just under 13. Now, in terms of the last 10 years, well, we can see it is up around 56%, although we do note it is somewhere away from the $950 that we have seen 3 years ago. Now, in terms of running through this, they don't have a dividend safety score, but we can still look at the other metrics. Market cap, 41 billion. It is a large cap company, and we can see they haven't increased that dividend just yet, so we are waiting for the latest full-year increase. However, over the last 5 years and over the last 10 years, we have seen some nice increases over the period. Now, in terms of looking at this information, now the first one is that free cash flow payout. As always, below 60%, my personal preference. They have hit that over the longer term, but one thing we do want to point out, 2023, it was very high at 93%. So definitely something to keep an eye on. Ideally, we do want to see this number lower down to around the 60% target level. In terms of the free cash flow per share, well, it has increased significantly from 2014 to the 2023 $15, although we can see it has been reducing over the last 2 years. But on a more positive tone, 2024 anticipated to increase to over $25 of free cash flow per share. In terms of sales growth, well, notably the more recent year, they are down -4%, and they have had 3 of the last 10 years as negative. But in the positive years, we do see some very strong double-digit increases. 2021 as well as 2022 looking very good. And if you are investing for the longer term, well, we can see they have doubled their top line, 10 billion in 2014, just under 20 in 2023. Shares outstanding, not much to talk about here. Very trivial amounts that they have bought back in for, just 4 million over the last 10 years. So we won't discuss that at the moment. ROIC, well, above 10%, and what we do note over the longer period, above 10%, 20% over 21 to 22, even though it has dropped into 2023, still looking strong at 13%, maybe something you do just want to keep an eye on. Operating margin, well, positive to note operational efficiency, given they have not just increased their top line over the last 10 years, but also their operating margin, although we can see it has reduced from the last few years in a downward trend. Free cash flow margin above the minimum 5%. Again, a little bit of inconsistency, but if you look at the last essential 9 years, it is above that minimum target. We then move on to the net debt to EBITDA. Now we do want to see a maximum of 3 to 3.5. 3.04 in 2023, anticipated to increase to 3.6 in 2024. So something we would just keep an eye on, given the fact that it has been increasing and the free cash flow payout was around 90%. I definitely would recommend to incorporate this into your investment thesis, as well as when you do come to look at that margin of safety. So let's jump into the valuation model for Kering. One thing that we will say, if you do want to grab a copy of this model, running your own numbers through to get your own intrinsic value and acceptable buy price, you can grab a copy by clicking in the pinned comment below. So a 10% margin of safety for Kering would indicate a buy up to $379, at 15% up to $358, at 20% again still looking like an acceptable buy, at 25% not quite there yet. So today's episode for Kering, we would say at least a 20% MOS level up to $337, but let us know whether or not, based on some of those indicators that we have seen, that is sufficient for you to consider this in the portfolio. When we take a look at Wall Street, they do indicate around 25% upside, so they do see this as a stock that you should consider to buy, and we did see Seeking Alpha give this a buy rating. So in conclusion, for Kering, a 20% MOS level with 25 implied upside based on Wall Street and their target. The next stock that we are looking at is Canadian Pacific Kansas City. Now what we note, a double buy rating, Seeking Alpha and Wall Street, again trading right there towards their 52-week lows, a yield on a trailing 12-month basis 0.75%, and a P that is 24.1, marginally higher than the S&P. We note over the last year pretty much flat, down 1.02%. Over the last 10 years though, it is up around 107%. Now when we discuss their dividend safety, we do get a score of 76 indicating safety, with a market cap of just over 71 billion, a large cap company, and last month it was indicated and reaffirmed that a dividend cut does look to be unlikely. Now last recession they did in fact maintain the dividend, there was no increase but also no cut or increase, and with a recession sales it was pretty much the average of the S&P, although their return did trail negative 64% return. In terms of dividend growth, well, they haven't actually increased their dividend since 2020, so a bit of a downer for a company that does have a below 1% yield. Over the last 5 years though, increased it by 9%, over the last 20, 11% year on year, and we do note, as we mentioned, 0 consecutive increases but 21 years of paying a dividend without a reduction. Now, dividend yield theory, we can see here, would indicate overvaluation / reasonable valuation on the yield alone. On the forward P, again, a very similar story of reasonable valuation with the yield in comparison to the 5-year average. And when we compare it, though, it is higher than the industrials that sits at 19.1. Now, when we focus on the free cash flow payout, unsurprisingly, given they haven't increased those dividends for the last 3 to 4 years, it is below 60%, although we can see 2024 expected to come down to 22%, so we would like to see them at least an inflationary increase over the next 12 months. In terms of free cash flow, well, as we can evidently see, it has been increasing over the longer term, but again, a little bit of inconsistency, very, very similar to Kering stock that we saw. It did peak in 21. It has started to come down, but we do know over the next full year, we are anticipating a large increase to the free cash flow. Sales growth, well, again, if you are familiar with this stock, the merger essentially with Kansas City, we can see some nice synergies to their top line, up 42%. So it will be nice to see where they move from this point forwards. Over the last 12 months as well, trailing 12-month basis, 49% increase to their top line. We can see their top line has doubled over the last 10 years, but again, bear in mind, previous to that merger, we can see their top line wasn't increasing that rapidly. In terms of shares outstanding, now, as always, we do want to see share buybacks. We did see it up to 2021, but again, they have increased that there. That is due to essentially the merger. Therefore, we would like to see moving forwards the reduction of shares that we did see from 2014 to 2020. Then we move on to the ROIC. We do note from 2014 to 2020, it was very strong, double digits that we like to see, but a lot of the numbers will be affected by that merger. And if you do want to see an in-depth dive into Canadian Pacific, then we have reviewed this company not too long ago. terms of margins, well, very strong, above 12%, but again, from the highs of 2020, it has started to come down, and this is showing again on the trading 12-month. Something just to keep an eye on, but we can see a lot stronger than the minimums we want to see, and the same exact story can be told on the free cash flow margin, significantly above the 5%, but again, it has started to come down, again with a downtrend confirming on that trailing 12-month basis. Net debt to EBITDA, nice to note, it has started to come down from the highs of 2021, 3.18 on a trailing 12-month basis, anticipated to go lower into 2024. So again, lots of positive signs with this company, their top line increasing with that merger, so hopefully over the longer term, this will be one of the best railroad companies to own. In terms of the valuation then, let's get into it, as that is always important once we are happy that a company is a high quality and we do want to execute on this in our portfolio. $82 currently the intrinsic value, margin of safety at 10%, does show us then it isn't too far off becoming a 10% MOS right now on these estimates and judgments. But what is very interesting is that Wall Street do believe this company is going to go much higher than our intrinsic value. They have upside of 21%, so they do indicate this as a strong buy and definitely one to consider, maybe more so as well if you don't have any exposure to this industry. We then move on to one which is definitely on my radar very strongly at the moment. It is Old Dominion Freight Line. We have a double buy rating with a hold from Quant, again trading right there towards their 52-week low. Now the yield isn't nothing to write home about, 0.6% on a forward-looking basis. Forward P as well, just under 29. It is up 10% over the last 12 months. Over the last 10 years, though, very strong, up 707%, and this is one that has continually outperformed the S&P 500. So in terms of dividend safety, well, 81, a very safe score. Market cap, 38 billion, a large cap company. And when we take a look, it was reaffirmed dividend cut looks to be highly unlikely for this company. And when we do see how they performed in the last recession, well, there was no dividend, so no comparative data, below average growth, and they significantly outperform the S&P, negative 22%. Now, name me another company as strong as this in terms of the dividend growth. It will be very hard to find. 30% increase just this year, 36% increase on average over the last 5 years, and we can see they have been increasing those dividends over the last 6 years consecutively. In terms of dividend yield theory, well, a severe undervaluation signal, 0.61 versus 0.4, and we do also note the forward P, 27.8, is below that 5-year rolling of just under 30, although the industrials sector P does sit much, much lower at 19.1. Now, in terms of the free cash flow payout, no surprises at all that it is low, given they have been increasing those dividends double digits, 22% in 2023, expected to increase but marginally to 27% over the next 12 months. What do I love? Well, look at this. The free cash flow has been growing very strongly, marginally inconsistent, but very strongly over the last 10 years. We do note a marginal increase over the next 12 months as well. Sales growth, well, they did note, in fact, their second negative year in 2023 at negative 6%. But prior to that, we do see a lot of very strong years, which has propelled their top line to more than double over the last 10 years. 2.8 billion to 5.9 in the more recent period. On top of that, they do a lot of share buybacks, as we can see, 258 to 220. So in comparison to the initial amount, that is some very, very healthy amount. So always great to note from any companies that incorporate that alongside a very healthy and strong double-digit dividend increase consistently. In terms of the ROIC, well, it has been increasing over the last 10 years. Very, very strong numbers. 34% and 44% over the last 3 years. Lots to like about this company. In terms of the margins, well, fantastic. Not only increasing their top line, but operational efficiency, 16% in 2014, 28% in 2023, and a very similar story with their free cash flow margin. It has been increasing over the longer term. In terms of their net debt to EBITDA, well, this is something that I don't think you can get any better, is when you see a company that has had zero for the majority of the last 10 years and into 2024. It won't even take them 1 day to pay off all of that debt net of cash on hand. So let's jump into the valuation. Don't forget, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button. It does really help the channel. And in terms of the margin of safety, well, the intrinsic value around $202. At 10%, a buy up to $182. at 15%, pretty much bang on the current trading price. For those looking at a 20% MOS, it would sit around 161. Now again, as always, for a high quality company, you could argue 15% is enough, but do let us know your thoughts below. And as we can see here, Wall Street do indicate upside near a 20% level with a price target of $203, not too dissimilar from our intrinsic value. The next one we're seeing is LVMH. Now we do have a hold rating from Seeking Alpha. It is trading right there towards their 52-week lows with a trailing 12-month yield of 1.8% and a forward P, or a P trading 12-month basis I should say, of 23.73. Over the last 12 months, it's down 16.44%. Over the last 10 years, however, up 287%. Now again, very similar to Kering, we don't have a dividend safety score, but we can still look at those metrics. Market cap, 391 billion, a mega cap company. Some very strong dividend growth, high single digit over the last full year, strong double digit over the last 5 as well as the last 20 years. And we can in fact see when we do look at that free cash flow payout, it is looking very healthy. At least that 60% or lower that we always like to see, although we note 61 in 2023. We then move on to the free cash flow per share. Now, it has been increasing over the longer term, around 4 times over the last 10 years. But again, similar to other companies, it has started to come down from the highs seen just a few years ago. Positive to report that over the next 12 months, they are anticipating growth to the free cash flow per share. In terms of sales growth, well, we do see double digit for the vast majority of the last 10 years. It did peak in 2021 on that COVID rebound from negative 17 to 44% and has started to come down since then. 9% though does look healthy on a trailing 12-month basis, and we can see nearly tripled their top line over the last 10 years. Similar to other companies, very minimal movement on the shares outstanding, although what we will say is the CEO has been doing a lot of shares buying himself in his own portfolio. In terms of the ROIC then, what we do know, very strong, above that 10%, 21 over the last 2 years, the strongest it has seen over the last 10-year period. So always a great sign, especially when considering management in your overall investment thesis. Operating margin, well again, operational efficiency increasing top line as well as their margins, and the free cash flow margin, even though it has decreased down to 12%, still very healthy considering 5% is the bare minimum that we do want to see. In terms of net debt to EBITDA, then again, below 3 is what we want to see, 1.67 in 2023, there or thereabouts over the next 12 months. So it is looking healthy, both on a balance sheet strength perspective as well as essentially a dividend safety. So what about the valuation? Let's have a look. Remember, as always, you can click on the pinned comment below to grab a copy of this model. What we see here is an intrinsic value of $910. Now, margin of safety for this company, 819 if you believe a 10% MOS level is accurate. 15%, well, 774. At 20%, not quite there yet. So in today's episode, we see at least a 15% MOS level for LVMH. Now, in terms of Wall Street and their forecast, well, they see 25% upside, $950, higher than our intrinsic value. So in conclusion, 15% MOS level, 25% upside based on Wall Street over the next year, but do let us know whether or not you agree. We then save the highest yield for last, that is Pfizer with a yield of 6.08%, a double buy rating with a hold from Quant. In terms of a forward P, it does sit just below 12, again right there towards their 52-week low. Battered, if you have seen our other videos on a deep dive, you will understand, negative 32%. Over the last 10 years, very minimal movement, and as we can see, it did peak in that COVID period at around $60. Now, dividend safety, well, 75 safe, which is nice to note for a company that yields over 6%. Market cap, 157 billion. It is a mega cap company. And again, reaffirmed just a few weeks ago, dividend cut for Pfizer does look unlikely. Now, when we take a look at the last recession, well, they did in fact cut the dividend. They did have above average growth, and they did also marginally outperform negative 45% recession return. Now, a below inflationary increase last December at 2.4%, in line with inflation over the last 5 years, and marginally higher over the last 20. And what we can see, 13 years of consecutive increases, and we do note that dividend cut during that recessionary period. Now, when we take a look at dividend yield theory, we do have a very strong signal of undervaluation on the yield, and also when we look at the forward P, it isn't too dissimilar from the 5-year average. For those that want to see the sector, well, healthcare does sit much higher at 16.6. Now, in terms of the free cash flow payout, as always, we do focus on this. We do say you can spot potential dividend cuts inbound. And look at that, 2023, it is estimated they paid out more in dividends than they generated in free cash flow. Massive red flag signal. The only positive thing we would say here, it is anticipated to come right down into 2024, but something just to keep an eye on moving forward. Free cash flow per share, well, again, very inconsistent over the longer term. In fact, pre-COVID, it barely moved. We did see that 21-22 jump, and it has rocketed down in 2023, but over the next 12 months, anticipated some massive increases to their free cash flow. And again, do check out our deep dive as we do discuss a lot of upcoming catalysts for this company. In terms of their sales growth, again, no surprises here. Very minimal movement and growth at pre-COVID. Post-COVID, though, we do see a negative 42% drop. And when you do look at it numerically, you can see, again, 2014 to 2020, very minimal movement. It did increase rapidly the following 2 years, and then since COVID, it has come down. In terms of shares outstanding, they have done some share buybacks. They have reduced it from 6.42 billion to 5.65. We then move on to the ROIC. Now, again, very inconsistent, very strong during COVID, but after that, come down to 3%, 2% on a trailing 12-month basis. And as always, lots of things to consider in your investment thesis, as well as in your own investor margin of safety. Operating margin, well, very strong pre-2023, and on a trailing 12-month basis, looking very low. However, on the free cash flow margin, even though it has rocketed down to 8% from the previous year, 27%, it is still looking fairly healthy. In terms of the net debt to EBITDA, very important, especially for a company that does pay a nice yield, 3.75. So that is higher than what we want to see, although it is expected to come climbing down to 2.58 in 2024, therefore giving us some faith in both balance sheet and dividend safety. In terms of Pfizer, well, what is essentially the intrinsic value? And in today's episode, it is the average of these models coming to just over $32. Now, with the price in the mid-$27 mark, we can see a 10% margin of safety would indicate a buy up to $29, 15%, pretty much around the current trading price now. So if you can secure Pfizer around this price, then you would be getting a 15% MOS level. In terms of upside, well, Wall Street actually believe it will be higher than our intrinsic value, 22% implied over the next year, indicating this to be a buy with a price target of $33.50. However, as always though, do let us know your thoughts in the comments below. Are you looking to add to any of these undervalued 6 dividend stocks? Maybe some of these are on your watch list, or for whatever reason, if you don't like them, do let us know your thoughts below. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.